I'm going to talk a little bit about what the ASX, as Tony's forecast, the ASX has done to help you make better informed and easier investment decisions. So I'm actually going to have a little bit of a look at us as investors, and I'm guessing many of us in the room are self-managed super fund trustees. Oh, all the hands go up. There's a few familiar faces I know that come along to, or that I recognise that come along to our sessions as well, so good to see you here again today. Apologies to those of you that are familiar with some of these slides. There's a few moving parts to it. But I'm going to have a bit of a look at trustees and investors and your investing behaviour, and maybe just present you with some opportunities and ideas to think about how you could invest a little differently in terms of the product that you choose to use. But here's some numbers that are actually available from the ASX, what we used to call the Australian Share Ownership Study. And a week today in this very room we'll be launching the latest version of that, and we've expanded to refer to it as the ASX Investor Study, because the ASX is a lot more than just shares. But based on the last survey, just under 6.5 million Australians, adult Australians own shares, 36% of the population, and importantly and uniquely almost to Australia, 4.6 million of those hold those shares in their own name, your name on the title, on a CHESS HIN most likely. And then again, another uniquely Australian occurrence, 1.1 million trustees of self-managed super funds have actually chosen to invest in what is now not 612, but 650 billion in self-managed super through the ASX. The ATO tells us that, and it tells us it looks a little bit like this. This light blue bar here, or slice of the pie here, is actually the amount of money, based on those out-of-date numbers, that's actually been invested through the ASX. So firstly, thank you. We appreciate your business. But we also think it's in recognition of the certainty of settlement, transparency, and the ease with which you can access investment. So we greatly appreciate your business, but it bears on our mind to some extent, because what we may have done, and I'll show you in a moment, created a bit of a problem for you, because whilst there's 2,200 listed companies on the exchange, we as investors in self-managed super funds are typically concentrated in the top 20, if not even tighter than that. What's our next biggest asset class that we've chosen to invest in? It's called cash. $160 billion sitting in bank accounts around the country. So we have this propensity to invest in higher risk Australian equities. And I didn't say risky, I said higher risk, because the rate of return is related to the risk. So if you are investing for the return, you are by definition taking most likely a higher risk. And offsetting that with lower risk, and as I think we all would agree, lowering returns. The cash rate at 1.5% is not inflation proof, and in fact if you're invested at that rate, and many accounts run at that rate or slightly below, you're actually losing money. So we have this barbell effect of investing in higher risk Australian equities offset by lower risk, to our mind, cash. But we don't fill it out too much in between. Cash at one end, equities at the other. So what we've been endeavouring to do at the ASX is to actually build out the spectrum that you can invest in between those two asset classes. Just before I go on though, and I'll come back to this at the end, what do you reckon was the best performing asset class over the last 5 years? Who thinks it was cash? Aussie bonds? Global bonds? Yeah. Australian equities? Global equities. Okay, a lot of hands. So the room says global equities. If I said 10 years? Cash? Aussie bonds, global bonds, Australian equities, global equities. Global still has it. I'm going to come back to that, but just bear in mind the earlier slide about where we are invested. So what the ASX has been doing is, I've developed this, and for those of you who've seen some of this presentation, you know the supermarket analogy goes on a lot further, but this is our car park where fund managers and those that are bringing product to market to access you as investors and perhaps to help you with your investment decisions come to deliver that product. We're well known as, and all these are electric cars because they don't make any noise, we're well known as the place for Australian equities, and effectively this is for capital raising. So you have a good idea, you want to start a business, you raise money through the ASX. It's an IPO, it's called a capital raising. We've done that for many, many, many years. But because of the efficiencies that I referred to earlier on, the transparencies and the avid way in which we like to use the ASX, fund managers started to say, well, let me package up some investment products and I'll distribute those through the ASX. So 50, 60, 70 years ago, listed investment companies were the first style of fund to actually come to the exchange, and they use a listed company structure and the stock in trade that they actually employed was actually listed shares. So it was a listed company that invested in other listed entities. Over the last 15 years, and there's been a lot of discussion about exchange-traded funds, which are part of this exchange-traded product group, over the last 15 years, ETFs have become an overnight success. Actually, ironically, it was the global financial crisis that made ETFs popular. When everything was going south, people put their money into an exchange-traded fund tracking an index that was declining, but the value and the weight of money going into those indices with the expectation of it turning around, and when it did, I'd be part of it, the value actually grew. So since the late 2000, 2008, 2009, ETFs have become very, very familiar to Australian investors. Perhaps not so much so over the last 2 or 3 years, we've introduced a service called the M-Fund Settlement Service that allows you to buy unlisted funds through the exchange and get a lot of the benefits of the certainty of CHESS and things associated with that. So there's a range of different product structures. There's reasons for this, and I'll come to that in a second. In fact, probably the next slide. The colours, as they transferred from our livery into the InvestSmart livery, don't come quite through as easily as I would suggest, but when you buy a REIT listed on the exchange, you are going to be exposed to property. There's really only one listed way to get exposure to property. Listed investment companies, predominantly Australian shares. Infrastructure funds, by definition, it's all about infrastructure, and there's about 8 or 9, or there's actually 9, soon to be one less with Duet coming off, I think, next week, large listed infrastructure funds on the Australian market. But when you start to look at exchange-traded products and M funds, you can see the variety of asset classes to which you can now get exposure beyond Australian shares in a different structural sense is far greater. So the encouragement is to move a little bit further along the spectrum and consider other product structures to get diversification. It's often said that diversification is the only free lunch in investing. So diversifying your portfolios between that extreme of cash and higher risk Aussie equities. So what have we done and what's the outcome of our endeavours? If you look at it this way, and we'll just take, this is us going shopping down the supermarket aisles. The first one is the domestic aisle, that's the Australian shares, that's what we're well known for. In addition to buying those 2,200 listed companies, there's now 63 ways through an listed investment company, or 41 ways through an ETP, or 49 ways through an M fund to get exposure to Australian equities other than buying a listed company. Global, an asset class that's very difficult to get pure exposure to overseas markets when you buy an Australian share. Same sorts of numbers, 26, 69, 47, and the values sit alongside that. $4 billion in listed investment companies, $10 billion in ETPs, and $31 million for M funds. Fixed income, an asset class that's not well known to Australian investors. Isn't that just term deposits? No, it is not. But interestingly enough, one of the things that we found with the M Fund service, this is the first asset class that a lot of investors went to. Other places you might want to consider going, property, listed property market. Second largest listed property market in the world with 51 REITs totaling $134 billion. ETPs give you exposure to that as well as do M funds. Infrastructure, I've talked about the small number of equity type infrastructure funds that are available, so too a few ETPs and some M funds. And alternatives, if you want to invest in commodities, real commodities, even the price of gold, silver, platinum, palladium, or oil, or if you want to invest in currencies such as the US dollar, you can actually buy exposure to an ETF or an ETP over those indices or commodity prices. There's been a lot of discussion today too about financial planners and advisors' role in helping you. The supermarket analogy sees you doing the heavy lifting because you're pushing the basket. This person here is your advisor. This represents the reality that we're now finding is that people are no longer just going to a financial planner and saying, here's my money, you run it. They're actually saying, I want you to work with me, be my coach, or be my validator. I've got some ideas. Here they are in the basket of goodies that I bought through the supermarket. You tell me if I've got the right one. And of course, people like InvestSmart can help you manage your portfolios and put it all in one spot and have a look and see what the value is and what those various product structures are delivering to you. So if you want to visit the entire supermarket, you'll need to use one of our ASX brokers as the access point. Now, a lot of online brokers, well, when you say online, people think that's not a stockbroker. Yes, they are. But here's some full-service brokers that play into that space, and they can take you down every aisle, every product range that we have in our supermarket. There's a growing number of brokers that actually having focus on financial planners. So they've built businesses around helping that new age group of financial advisors that want to talk to people such as yourselves about your direct investing or your self-managed super fund trustee needs for investments. These guys actually cater to the financial planners. And then finally, for those of us that like doing it ourselves, there is a range of online brokers that many of you, or names that you'll be familiar with, that can help you get direct access to the full supermarket. So just back to my questions. What was the greatest number we said for the last 5 years? I think we said global equities. You are right. Hey, cheers in the front row, or second front row. Does not include franking, but this is the total return, capital appreciation as well as income. Where were the largest number of hands for the 10 years? I think you were saying global as well. Who would have thought? Global bonds. 10 years ago, we probably didn't even think about bonds. So had you been in the market for 10 years in bonds, you would have done reasonably well, albeit a lot less than over the last 5 years. So I'm going to finish up there and pass back to our host, or to pass on to our next speaker. So thank you, Tony, very much for the opportunity to speak with you. And to you, ladies and gentlemen, thank you for your attention. Good afternoon.